So you have this bank, right? Silicon Valley Bank. For years, it was an absolute institution, a pillar of the tech and venture capital world. And then, almost literally overnight, poof, it vanished.
And that's the big question, isn't it? How on earth does a major, respected bank just disappear in 48 hours? It sent shockwaves through the entire financial system, because this wasn't some slow, predictable decline. It was a lightning-fast, catastrophic collapse. The story of how it happened is, honestly, a wild lesson in modern risk.
Okay, I want you to just let this number sink in for a second. $42 billion. That is how much money people tried to pull out of Silicon Valley Bank in a single day.
Now, you have to understand, this was not your grandfather's bank run, with people in trench coats lined up for blocks. No. This was a new breed of panic. A digital bank run, started in Slack channels, fueled by tweets, and executed with a tap on a banking app. To really get how this was even possible, we got to rewind just a little bit.
So to understand the collapse, we have to go back to the boom times of 2021. The tech world was basically on fire. VCs were throwing money around, and SVB was just flooded with cash from all these startups. Their deposits basically tripled in no time. But what they did with all that money, well, that's what set a ticking time bomb.
All right, let's take a look under the hood. You can see here, deposits dipped a little in 2022. Okay, fine, the tech boom was cooling off, but the real flashing red light is this row right here, unrealized losses. Just look at that jump. It went from about $1 billion to over $15 billion in just 1 year. That is just staggering.
And here's why that $15 billion number is so absolutely terrifying. That massive loss on paper was nearly the same size as the bank's entire capital cushion, about $16 billion. So think about that. If they were ever forced to actually sell those investments, the losses would have effectively wiped them out completely. They were living right on the edge of a cliff.
And this is the other crucial piece of the puzzle. An unbelievable 94% of all the money held at SVB was uninsured. It was over the $250,000 FDIC limit, so we're not talking about small savings accounts. We are talking about the corporate treasuries of huge tech companies. These depositors were savvy, they were all connected to each other, and they had absolutely zero reason to stick around at the first whiff of trouble.
So you have this incredibly fragile situation just waiting for a spark. And when that vulnerability met the insane speed of social media, the result was just pure chaos. Let's do a play-by-play of how it all fell apart. So it all kicks off on a Wednesday. SVB makes this announcement they were trying to project strength, saying they'd sold some assets and were raising more money. But to the market, it just screamed desperation. And that announcement, it was the match that lit the fuse. By Thursday morning, this was the kind of message flying around X and private Slack channels. We're talking about major, influential VCs, not just suggesting, but pretty much ordering their companies to pull their cash. It was a digital firestorm.
By the end of business on Thursday, after processing $42 billion in withdrawals, SVB wasn't just out of money. They ended the day with a cash balance that was negative. Almost $1 billion in the red. I mean, just think about that. A bank with less than $0. And if you can believe it, it was about to get so much worse. Because waiting in the queue for Friday morning was another $100 billion in withdrawal requests. The regulators really had no choice. The bank was effectively gone. They had to step in and seize the whole thing before the markets could even open. Okay, so we've seen what happened, but the really interesting part is why the bank was so trapped. Why couldn't they just sell some of their assets to get the cash they needed? Well, the answer lies in a really specific and ultimately fatal accounting choice they made.
So the key term you got to know here is held to maturity, or HTM. It's basically a label a bank puts on a bond, saying, we intend to hold this thing for its entire life. And the huge benefit is that you don't have to report those scary temporary losses like that $15 billion we saw earlier. You can basically just pretend they don't exist.
So SVB had a choice. They could classify their bonds as available for sale, which would let them sell them easily, but would force them to report those huge losses. Or they could classify them as held to maturity, which let them hide the losses, but basically locked up their money. They chose to hide the problem.
And this, right here, this was the trap. It's almost diabolical. The second they needed cash and tried to sell even one single bond from that HTM portfolio, accounting rules would have forced them to reclassify everything. That would make the $15 billion loss official, instantly proving to the world that they were insolvent. They were completely paralyzed. The very assets they needed to sell to survive would have triggered their own death warrant.
You know, the collapse of SVB wasn't just the story of one bank that messed up. It was a massive wake-up call that has totally changed the rules of the game for banking in this digital age. It forced regulators to act incredibly fast and rethink how they look at risk entirely. So to stop the panic from taking down other banks, the government did two pretty extraordinary things. First, they invoked a systemic risk exception and guaranteed every single deposit at SVB, even the ones that were uninsured. Then, they created this brand new emergency lending program that basically allowed other banks to borrow money using their bonds at their original value, ignoring the current market losses. It was a way to diffuse that same HTM trap for the rest of the system.
So what do we learn from all this? Well, a few big things. First, social media sentiment is now a core financial risk factor. A bank run can happen in hours, not days. Second, having all your eggs in one basket, like having all your depositors come from the tech industry, is incredibly risky. And finally, you better believe that regulators are looking to close the loopholes that let a bank as big as SVB avoid the toughest financial stress tests.
And all of this leaves us with one final and kind of unsettling question. Sure, SVB was a unique situation in a lot of ways, but the tools that brought it down, our smartphones and social media, they're universal. In an era where billions of dollars can be moved with a click, it really makes you wonder if any bank is truly safe from a digital stampede.